Hello there. This is Harrison Bonner from the Wollaston Wealth Management Fund. What I'm going to be doing with you today is I'm going to be taking a step-by-step look at a pro forma for 156 High Street. This is the next asset in our line of acquisitions for the Wollaston Wealth Management Fund. So what I'm going to do is I'm going to walk through our pro forma with you, demonstrate how it works, demonstrate how the cash flows from the fund into the asset, and then how the asset is projected to perform over the hold period, and then how those cash flows ultimately come back to the fund and to the limited partner investors. So we will start here on our performance summary tab of our pro forma. We have two tabs here in the spreadsheet. We have our performance summary, which is the highest level overview of the fund's performance with this one asset in this case. And then the second tab here is the specific performance or performance of the asset itself. So we'll dive into that second. But we'll start here in the performance summary. Over here, we have some key percentages to keep in mind. So remember, our fund is an 8% preferred rate of return. So the first 8% of all profits will go to the limited partners. And then the profit share pool, which is any profits above and beyond that 8%, are split 80-20 with 80% to the limited partners. I have here $500,000 investment from the fund into this asset. We may not quite need the full 500,000 to see this through to the end, but I wanted to project conservatively and overestimate the equity needed to get this across the finish line. And here you'll see some return metrics. Something to keep in mind is anything highlighted in green is specifically related to the limited partners and their cash flow. Anything highlighted in the yellow are numbers that are specifically related to the fund as a whole. So the way this breaks down here is in our columns, we have performance and equity for year 1, 2, 3, 4, and so on. So here at the top, we start with a $500,000 capital account balance. Now, year 1 is all development, right? This property needs a full gut renovation. We have teams in place ready to get this going. But while a property's in renovation, it's obviously not going to cash flow because there's no tenants. We then have some fund expenses. So tax preparation and miscellaneous expenses, make sure we're accounting for those. A little bit higher in year 1 than in the latter years due to expenses getting the fund set up. In this expense line here, we have our asset management fee. So this is 2% of equity under management for that year, which is the $10,000 asset management fee to the general partner. This allows us to make basic expenses to keep our lights on during the course of the capital deployment. And then this row here gets into annual profit. As I said, on paper, there's not going to be any profit from year 1 because it's all development. So it shows here as a loss. I'll show where that pulls from in this other tab in just a minute. And then we have our limited partner preferred rate of distribution first. So remember that first hurdle that we have to cross, that first 8%. And if this 8% is not met, as you'll see here in year 2, as we're starting to ramp up our cash flows, if that preferred rate of distribution is not hit, then all of the profit share goes to the limited partners. So that full profit goes to the limited partners with none to the general partner. And then there's a catch up at the end that I'll demonstrate on the exit as well. We have a metric here for cash on cash return year by year. And then here we have a property value section. So this is just estimated property value by year based on a 7% cap rate. So we have seen cap rates in the 7s in our market. And so I've used that to estimate the value year over year based on the property's performance, which gives us our estimated property value. We have our primary lien. So this is the principal balance for our primary lien for our construction that's already in place. And then equity, which would be the difference between the value and, and the debt. So, and then I have the 80% equity to the limited partner, 20% of the equity by the general partner, just to to demonstrate how the equity grows over time as well. So you'll see here in year 3, we have a refinance event here, a liquidity event. So I'll demonstrate that more on the next tab. But this would be our expected cash back from a refinance event after the property is stabilized. So this may occur in year 2, but I have it projected in year 3, again, to be conservative. So if we can hit all of our numbers, we can stabilize our asset, and then we can take this to a bank to refinance this. We project about $362,000 in return of capital from the refinance event. And then what we'll do with that is we will then take $300,000 of that and return it to the limited partners as a return of initial capital to get ahead on that return of initial capital. This helps your cash on cash return accelerate in the latter years, as well as just de-risks the investment for the limited partners by returning a portion of their investment capital sooner rather than later. And then here we just leave $62,000 or so in cash on hand just as reserve, which is just good practice. So then you'll see here in year 4, the account balance, because we've now returned this $300,000 to the investors, is $200,000. We have our cash flows, expenses, annual profit. Limited partners are getting that 16% preferred rate of distribution because we're hitting that this year. The balance goes into the profit share, with that profit share being split 80-20. And that's getting distributed every year. So then if we go over to the exit, at the end of year 5 is roughly going to be our sunset window for this asset. So this one we'll look to, we've now maximized the cash flow over a couple of years. We've maximized the value of the property, and we need to close the fund down. In this case, this is single asset fund, right? But this is to demonstrate the performance of this one particular asset that we have next in line to acquire. But we have our property sales here, so the property should be worth roughly $2.2 million by the end of year 5. We have some selling expenses here, gross to seller. Now, of course, we have to pay off our primary bank loan after our refinance. So this will be the primary loan payoff, our net to seller. Now, here's where we start to have cash flows go back to the limited partners. So, of course, we need to return the additional $200,000 of initial capital that's outstanding. So that gets returned first, along with the preferred rate of return catch-up, which are from these years here, where the preferred rate of return was not quite met, but we catch it up here on the end. This could also be caught up here in the middle, but for simplicity's sake of the model, I have it being caught up at the end on the exit. And then the balance remaining is the fund profit, or that profit share. So we add in our cash on hand, so any reserve capital that we have into the profit share pool, and we end up with roughly $546,000 to be shared 80-20. So 80% to limited partners, 20% to the general partner. In this chart here, I have annual cash flows to work to our internal rate of return and our equity multiple. So capital investment year 1, or initial investment, $500,000. This is the cash flows in years 1 through 5. So remember, year 3, there's a big increase because there's a return of initial capital. So this kind of helps with your time value of money factor as you work to get to that internal rate of return formula. So with a $500,000 investment, we would expect at the full exit of the asset to return a total of just over $1.1 million, which gives us a 19% internal rate of return and a 2.29 equity multiple. And that is then demonstrated here. So that is how this performance summary flows. And then if we get into the asset itself, we have this broken down year by year. And then we also have all of our income sources and expenses broken out as well. So we have today's performance. We do have one tenant in there. It's paying $800 a month. It's one of the commercial spaces that'll get renovated, but not a huge factor in the in the overall performance, the majority of the performance is going to come from the residential units, but their rent will increase as that unit is renovated. So it's kind of barely keeping the lights on here as we work into the development phase. So then again, we have columns for year 1, 2, 3, 4, and 5. Income, total income here. Our expenses, so we have a 7% property management expense, obviously taxes, insurance, total utilities, and I've hidden a lot of these rows, but we've broken a lot of these down so you can see really where we are expecting the funds to be going. And then, of course, we have our net operating income, debt service, and cash flow. And then here's where we have that refinance event projected in year 3. So we are using that 7% cap rate to get to our property value. And then some other key percentages that I used in estimating what a future loan may look like are a 70% loan to value and a 7% interest rate, with the debt service being interest only payments. I just sort of projected right down the middle. Obviously, we hope to get the best terms that we can at the time. Maybe interest rates are a little lower than that in a couple of years. But I used these sort of round numbers to estimate kind of right down the middle of what we would hope to achieve based on rates and leverages today, which gives us that $362,000 cash out from the refinance. So this is also broken out by month. You can feel free to go through by month each year. But yeah, so highly detailed to really get into where the money is going and where it's coming from. But if you wanted to stay super high level, you could just stay here on the performance summary tab, and it will tell you the majority of what you would want to know as a prospective limited partner investor.